All right, all right. Good morning, everybody. How you guys doing today? It's great to see everybody showing up first thing in the morning. I know it's not the opening bell, but we are here at 8 o'clock, and that's good enough for me. So let's come in and talk a little bit about Tesla. I promised that out on the little marquee, out on the thumbnail, we were going to talk about Tesla today, and I want to talk to you about two different versions of Tesla. There is TSLA, which most of us are familiar with. That's the Tesla stock. You see that over here on the left-hand side. And over here on the right-hand side is TSLY. And most people are not familiar with this one. They're like, what the heck is that? TSLY. And why is there a difference? Why is there two versions of Tesla? Well, the one on the left, being the one that most people are familiar with, is the growth version. The one on the right is the equity version, or what would, where you would get dividends. All right. So this one provides dividends. This one provides growth. Now, does the one on the right that provides dividends not provide growth? No, it certainly does. It provides growth, but the way it provides its dividends is very unique. All right. Now, there's a few stocks out here in the stock market world that that do this, and they provide dividends by trading covered calls on their stock. Okay, so it's an ETF, it's an exchange traded fund, and they trade covered calls against it. Now, a couple that you may be familiar with that are a little bit more familiar to you than or popular than TSLY is JEPI and JEPQ. So you have JEPQ. We'll open that one up. Let's just go full screen. And then there's JEPI, JEPI and JEPQ. So those are two very popular high dividend paying stocks that you can trade. You can hold these, and they are very similar to trading the S&P 500 and the QQQ or the NASDAQ. And so what we have is you are, instead of trading the S&P 500 or SPY, where you get growth, you would trade JEPI, JEPI, where you get dividends. All right. Same with JEPQ. Instead of trading QQQ, where you get growth, you would trade JEPQ, where you get dividends. Now, what are dividends? I mean, I think most people know what dividends, but let's talk about them a little bit. Dividends primarily, if you want to talk about it in the traditional sense, is when a company shares their profits with you through their stocks, okay, through the stock portfolio. So what they do is if they make extra money, they're like, oh, hey, let's give it to the people who own our shares, our shareholders. That's how they share their profits with you. All right. So then they give it to you in a dividend, and usually it comes out every quarter or every month. And then that dividend is something that you can take and use as income. Now you can do anything with it. You can go spend it. You can buy toys with it. You can go buy rent with it with your house or on your apartment, or you can make a house payment with it, or you can buy food with it, or you can reinvest it back into the stock, right? Most people just reinvest it back into the stock because most dividends they're almost not worth having. Let's go look at a high dividend stock, should we? Let's go look at one. We're going to call it T. This is T-Mobile. T-Mobile has what they consider to be high dividends. All right. So we're going to go over to a tool that shows us what the dividends are. And that tool is, if I can find it here for us, I use this tool. Lots of tools show you. I mean, Yahoo, Google, lots of software programs will show you the dividends. But this one I like. It's called FinViz, and it just shows you his little circles down here on the bottom of the chart. So let's go look over here, and we're going to look at T. We're just going to pull up T, and I'm going to show you the dividends. And I'm going to get around to it. You watch. I'm going to show you the Tesla dividends in just a second, but I kind of want to take you through this progression of what this does. So this is considered a high dividend stock because they share their profits with you, and this is AT&T. So if we hover over this, you can see that they give you 27 cents for every share that you own. All right. 27 cents for every share that you own. Now, their shares are $23.40 a piece. So let's go ahead and do a little math. Now, I call this UBI. All right. Just for fun, I call it UBI. Now, technically speaking, in my world, T is not UBI. UBI is universal basic income, right? Which is something that a lot of people are talking about nowadays because they are worried about AI taking their jobs. right? And so they're like, oh, we need UBI. And everybody's turning to the federal government and saying, how are you going to give us UBI, universal basic income? If AI comes and takes our jobs, we're not going to have any work. We're not going to have any money. And so everybody's worried about the government providing them with UBI. Well, what is UBI, universal basic income? Well, what else can take your job besides AI? Think about it. There's something else that can take your job besides AI, old age, right? Old age can take your job. And so the government stepped in and said, well, old age is going to take everybody's jobs. So let's set up a program. Let's set up some UBI for them, universal basic income, and we'll call it Social Security. So Social Security is UBI. It is universal basic income for people whose jobs were taken because of old age. That's what UBI is. It's just universal basic income. And if you turn to the federal government to do that for you, that was their solution then. And how are they going to do better than that now? The federal government is trillions of dollars in debt, right? And they're running the Social Security program into the ground. So anybody who thinks that they're going to turn to the federal government for their savior as UBI, universal basic income, where's my universal basic income going to come from? It ain't going to come from the federal government. They can't balance their own checkbook, let alone provide you with UBI beyond what is already being done for people who are old age, losing their jobs because of, and have a Social Security safety net, right? It just doesn't work. They're running out of money in Social Security. What makes you think they're going to have money to give you UBI when jobs fail because of AI? It's going to come from the capitalist community, all right? It's going to have to come from the capitalists, and the capitalists are going to have to provide this, and we've already been providing it. There is already a UBI system. You just need to recognize it, understand it, and come and participate in it, and it's the stock market. The stock market is universal basic income, and that's what dividends are. Dividends are universal basic income. They give you income from owning a company, all right? So let's do a little math. Pull out your little calculator here, and let's pull up the calculator in here, and we're going to do a little math. And you could do this along with me. It's very simple math. I don't need to make it fancy with a spreadsheet or anything. But let's say that you have $100,000 that you've saved throughout your life, all right? 100, let's just make it easy. 100,000 with the math. So we got $100,000, and we're going to divide it by the number of shares of AT&T that we have. AT&T is currently trading at $23.41. So we divide 100,000 by 23.41. That gives you the number of shares that you can own, the number of shares that you have if you have $100,000 in AT&T. All right. Every quarter, every 3 months, they're going to give you 27.278, basically 28 cents. 28 cents for every share you own. All right, that's your UBI. That's your universal basic income. That's your share of the profits of AT&T. So let's multiply 4,271 shares by 27 or 28 cents. So we're going to go times 0.28 equals. So they're going to give you $1,196 every 3 months for owning AT&T. That's your universal basic income. And that's why you have been told that you need about $2 million to retire, so that you can have a universal basic income coming in from dividends that will give you a sufficient amount of money to live off of so that you can retire. All right. You can have universal basic income. And the problem with that is coming up with $2 million is very difficult. All right. You can work your whole life, save as hard as you can, and getting that $2 million is extremely difficult. So people do a lot of things to try and get that $2 million. If you have $2 million, you can live off of UBI, universal basic income, or dividends off of your shares. So that's the concept, and that's the way the concept has been for years and years and years and years. But most people have a really hard time getting to that point, right? So they have to go out and do other things. What do? Well, they buy real estate, and they invest in real estate. So real estate can give you an income. You can buy a house and rent a house and get money from that. But the problem with that is, you're lucky if you can get 10%. a month on, or 10% a year annualized return. And most of that just goes to the bank because you get a 30-year mortgage on it, right? And then you pay it all to the bank. And in 30 years, at the end of the 30 years, you have a $300,000 house that you're paying rent on, or $400,000 house that you bought 30 years ago. And that's the rental process, right? So you can continue to try and build up what we call doors, right? And I have, let's see, I have 1, 2, 3, 4, 5, 6. I have 7 doors. Okay. So what does that mean? That means I have 7 units that are for rent. And that's what I've done to help me build up some income. And that was the old fashioned way, in my opinion. That's the old fashioned way. Right? Real estate is very hard. Why? Because you have constant upgrades. You have to constantly be dealing with tenants. You have to constantly be worried about insurance and somebody slipping on ice and falling and cracking their head open. You have to constantly be fixing toilets. You have to constantly fixing, all kinds of problems, painting the house, doing all that, removing the snow, mowing the lawns. All that kind of stuff is a real pain when you're doing real estate. But people generally think that it's easier to get into real estate and do real estate to get rich. And you can, parlay it and move it over and do all that stuff. But there's another way. There's another way. And if we look into the world of dividends and we look into the world of stocks, you don't have to have $2 million. You don't have to beg, borrow, and steal your first child to get there to retire. And so most people end up, they spend everything that they make and they end up on Social Security, living off of $1,500, $1,800, $2,000 a month on Social Security. And they paid their house off, so they have no payments, and they just kind of live a very basic, simple life. Well, if you want better than that, we're going to have to do something a little bit different. All right. You don't want to go into real estate. You don't want to have 7 doors. You want to start doing something else. Well, guess what? You're not the only one who thought of that. All right. So there's other people, professional people in the world of finance who have thought of this. And that's where we come back to JEPI and JEPQ. So if we go to JEPI and JEPQ, what they do is they said, well, you know what? Dividends are not good enough. AT&T is one of the best there is. And they give you on $100,000, if you were able to save up $100,000 and give it to AT&T to run their company on, they're going to only give you every 3 months $1,100, or basically what, $300 a month? With $100,000, $100,000 is a lot of money. Hey, it's hard for a lot of people to save up $100,000. So, if you're trying to live life and have things to do and a family and kids, how are you able to pick up $100,000 and give it to AT&T just so that they can give you $300 a month? That's a tough thing. And so other people have thought of this. And so what they've done is they've come up with other ways of creating more money or more dividends, make the dividends bigger. And so what they've done is, this is what JEPI and JEPQ are. All right. So JEPI and JEPQ is JP Morgan Chase, big banking company. And what they did is they said, well, let's sell premium from options on the S&P 500 and on the QQQ, on the NASDAQ. If we sell options premium, now for those of you who are familiar with options, you know that you can buy an option and you can sell an option. So we have 2 kinds of options. We have call options and we have put options. And you can buy a call or you can sell a call. You can buy a put or you can sell a put. Well, for everyone who wants to buy a call option, somebody has to sell it to them, right? There's got to be 2 players, one for each side. Well, it's very common for retail traders to buy. Big traders will do it too. I'm not just retail traders, but for traders who think the market is going to go long, they'll buy a call option, right? They buy calls. Well, somebody has to sell them that call. Well, when you buy a call, you have what we call a premium, right? So you pay for the premium. You buy a call option, which gives you the right, but not the obligation to buy the underlying stock at a specified price, which we call the strike price. And then that costs you a fee. So you may pay, and in fact, we can actually even come down here and look at this and go to AT&T and look at their options. So if we come into the options chain in AT&T, and we come down to our options chain, and we're going to go out, let's go say we want to buy a 186-day option. That would cost us $211. We would pay $211, and someone else would have to sell that to us. They would sell it to us, and they would collect the premium. Whoever sold it to us gets that $211, and we get the right to buy the right to buy AT&T at the current market price, which is $22 a share, and we had to pay $211 for that right. Well, these smart guys started thinking, and they're like, hey, you know what? We could take that premium that we sell, or that, when we sell these options, we get this $200. We could take that and turn it into a dividend. So now we don't have to rely on the company giving us shares or giving us profits on their shares. What they do is they sell the premium against it, whoever wants to buy a call option on AT&T, for example, and they then pay $213. Well, the company who receives the $213 then pays that back out as a dividend. So you're getting options premium as a dividend. And now this is called a covered call, the way it does this. Okay. So if you trade covered calls, and if you've been in the trading world for any amount of time, you've heard the term covered call. You may not know how to do them, and that's fine. You don't need to know how to do it because the professionals are going to do it for you. All you need to know is and understand is that options are bought and sold. And for whoever's buying the option, they have to pay a premium. Whoever sells the option gets to receive the premium. And the premium is an amount of money that's collected for selling the option. That's what the 216.50 is. It's down here in the left-hand corner. Oh, I'm in the way. You can't see it. There we go. So see that 216 down there in the left-hand corner? That is your UBI. All right. Universal basic income. If you start selling premium, start selling options, you now start collecting premium. Now, and for the longest time, people have done this themselves manually. That's like a great thing, right? Go out there and sell premium, and you'll hear people on YouTube telling you to do it all the time. Oh, sell naked putts or sell covered calls. And it's a great thing. And I teach it, and we do it all here, and I do it all the time. And you collect premium. It's a way to do it. But a lot of people are like, well, that's a little bit beyond me, Lan. I can't really get into trading options. I'm not that smart. I just want something easier to do. Can you do it for me? Right? That gets a question I get all the time. Can you just do it for me? And I'm like, no, I don't trade other people's money. But there are people who do. And so let's go and take a look at JEPI and JEPQ. That's what JP Morgan Chase does, right? They're in the business of trading other people's money. And so they come up with this idea, and they said, hey, instead of just relying on companies to share their profits with them, because companies like Apple, let's go look at Apple. Apple doesn't share their income with you hardly at all. This is AT&T every 3 months giving you 27 cents or almost 28 cents for every share that you own. Well, let's go look at Apple, big popular company that everybody loves, right? Well, they should share lots of their money, right? Lots of their profits. Well, no, they don't. Well, they do about as good as AT&T, I guess, 25 cents. 25 cents every 3 months. And that's considered a lot, all right? That's considered pretty good, 25 cents every 3 months. But the difference is the AT&T shares are how much? $25 a share. Apple's are $248 a share. That makes a big difference. So although they may still give you the same dividends, 25 cents, dividends are based on the number of shares you own. So if you have $100,000 and a share is $248, you don't have very many shares. So although their dividend amount is still the same, 25 cents, they only give you 25 cents for every share you own. And every share is $248 in Apple versus $25 in AT&T. So you're going to get a lot more money, a lot more dividends in AT&T than you are in Apple. Apple doesn't share their dividends very good. Why? Because they consider themselves a growth company. All right. And they're like, oh, we grow so much that you make so much money on your growth that we don't share our dividends with you. So let's now, as we were talking about Tesla, let's go over and look at Tesla. So this is, well, actually, we're jumping ahead of ourselves. Let's go back over and look at JEPQ and JEPI. So let's go look at JEPI, JEPI. All right. So JEPI is a fund that they trade options on. So they sell premium, collect the premium on the options, and then they turn that into a dividend and they give it to you. And it's on the S&P 500. So JEPI is the S&P 500 selling options, dividends, collecting it. So it should be a little bit higher than AT&T, right? So let's go over and take a look. That's the whole idea, JEPI. And we should get a higher dividend because we're collecting premium. And notice that, first of all, the little dots along the bottom of JEPI are every month, not every 3 months. So now you're getting it every month, and that helps you compound more. If you reinvest your dividends back into JEPI, you get to compound your dividends. And so one of the 7 wonders of the world, right? Being able to compound. So where you're going to start getting dividends on top of your dividend money. That's dividend reinvesting. So you come in and you click on it and you're going to get 40 cents. Look at this, 40 cents for every share that you own. And the shares of JEPI are only $59. They're twice as much as AT&T, but you're getting twice as much money. You're getting 40 cents for every one. So if we come in here and we come in and we go, all right, I've got $100,000, 100,000, and we're going to divide it by the number of the dollar shares, divide it by 59.52, 59.52. We're going to have about 1,680 shares. And every month we're going to get 40 cents times 0.40. That's JEPI. Now you're going to get $672 on JEPI, where you was only getting $300 on AT&T. See how that works? Now you got double the amount of money, and you're getting it every month, and you can reinvest your dividends back into JEPI, and you can now start getting free money on top of free money, right? Get dividends on dividends. So if you get $100,000, you now get $672 by putting it into JEPI, and they'll give you that money every month. That's pretty cool. Okay. Plus you have the growth. What if JEPI grows? I mean, it's based on the S&P 500, so it's going to rise in price, right? Now, if you understand how covered calls work, there's a limited amount of growth that you're going to get, but you're trading that limited amount of growth for your dividends. And so your dividends end up being $672 a month for $100,000 worth of JEPI. Now, let's go and look at JEPQ. All right, JEPQ. We're going to pull up JEPQ, and you'll notice that JEPQ also has little circles every single month. All right, so not quarterly, monthly. And look at this one, JEPQ. They give you 50 cents for every share that you have. Now, it's not based on dollar amounts, it's based on number of shares. And that's important to understand, because if you buy Apple's was what? How much was Apple shares? $500, $400 or something per share? $300? I can't remember. What was Apple shares? Let's go look. AAPL. Apple shares are $248 a share. And remember, you get your dividends, your 40 cents, your 50 cents, based on the number of shares you have, not the dollar amount that you're investing, the number of shares. So if we go back over to JEPQ, it's easier to buy 50 more shares if they're less expensive, right? $57.97. So now let's go do this one. So it's $672 for JEPI. Let's do JEPQ. So we're going to come in, we're going to take our $100,000. We're going to divide it by 57.97, 57.97. And we're going to equal that. And we have 1,725 shares. We're going to times that by, and the last time they paid dividends, they paid out 50 cents a share. Let's go 50, it's 50.8, so 51.51 equals $879. So you went from $600 to $800 by going from JEPI to JEPQ. Why? Well, JEPQ is the QQQ. That's the high-tech companies, right? So it's a little bit more volatile, but look at the growth on it too. It's got good growth. So your JEPQ is growing, it's making money, and you're getting the dividends. Now, remember, these dividends are not coming from the shares. Well, partially they are, a small percentage of them, but they're coming from selling covered calls. So they're collecting premium and you're getting covered call money. That's how they can do these bigger numbers. All right. But remember also, JEPI and JEPQ, they're based on the S&P 500 and the NASDAQ, which was 100 stocks. So it's a very stable market. There's not a lot of volatility in there. So they're considered to be very stable. All right. So it's just the S&P 500. JEPI, QQQ is the JEPQ, and you're getting 50 cents for every share that you own. That's a pretty good UBI if you can get that universal basic income coming into you. Now, I want to show you an individual stock. Let's go down to an individual stock. There's a company that does this on Tesla, TSLA. All right. So if we pull up Tesla, I'm going to come in here and I'm going to use Track and Trade to lay these side by side. We're going to come in and I'm going to remove this one. We're going to remove this one, and we're going to remove this one, and we're going to just bring up Tesla and Tesla. All right. So we're going to put them side by side over here on the left-hand side. This is Tesla. And you can see that I have an option on here that we've sold. So we're collecting premium. How much are we collecting? We're collecting $350 on the put option that we sold. Now, this strategy that this company is doing, they're not doing put options, they're doing call options, but it's the same concept. When I do it myself, I like to do put options because then I can buy the shares if I want to and take advantage of the growth. Once I own the shares, I can then do call options, and I can do that too. So I'm doing it manually myself, and I've been teaching that to people for 10 years. All right. 15 years we've been teaching people how to buy and sell options. And so that's the process. But now it's like, you know what? I get a lot of people. I teach at the university. I teach classes at the university. I've been teaching this online. I've been having students where I've been teaching this for 15 years. A lot of students like the idea or the concept. They're like, hey, this is a great concept. I'd love to get into options, but it's just a little bit too much for me. I just can't do it. It takes a little bit of energy, practice, and understanding to trade these options like this. And it's a little scary and intimidating. I wish there was an easier way. Well, there is now. Now there's a company that comes out and they actually have TSLY. So TSLA is your growth. That's where we used to do our own options selling. This company now created a new ETF, exchange traded fund, that you can invest in called TSLY, TSLY, and you can give them your money and they will trade the covered calls for you, and they give you them back, the covered call premium that people are paying them for, right? Because they're selling the premium. They're not collecting it. They're not paying it. They're selling them. So therefore they're collecting the premium, and then they return that to you as a dividend. So if you give them your money at TSLY, they will trade covered calls with it and then give you back the money. Now, the difference between that and other dividends is that if you just go buy dividends from AT&T, for example, every quarter you're going to get your dividend, and it's almost exactly the same every single month. You get, every single quarter, you're going to get your basically $300 on every $100,000 you've given them, just like almost like clockwork. It doesn't change very often. Well, because they're doing options premium, that amount can go up and down quite significantly based on how the market moves. So if the market's very aggressive, you might get more. If it's very quiet, you might get less, or vice versa, depending on the strategy that they're using. All right. So here is Tesla on the left-hand side and TSLY, TSLY on the right-hand side. And let's go in and look and pull this up. First of all, we're going to go in and we're going to pull up TSLA, and we're going to see what they're, look, TSLA, no circles, no little circles at all. Tesla is a growth company. They don't share their dividends. They don't share their profit. None, zero, zip, none. Okay. No dividends on Tesla. Let's go look at TSLY. All right. So here's TSLY. Now, if we give TSLY our money, let's give them $100,000. Let's come in here and once again pull up our little calculator, and we're going to give them $100,000 just like we did JEPQ or JEPI. Now remember, JEPQ and JEPI are ETFs in the sense that they have a basket of funds, not just one individual stock. So they're a little bit safer. Doing an individual stock like this is a little bit more aggressive. It's the same as going out and selling covered calls or selling naked puts, cash covered puts on your own on Tesla. They're just doing it for you. All right. And then they're going to share the money with you. Now they charge you a good hefty fee for doing it, but let's go see if it's worth it. So we're going to come in here, and again, let's take our same $100,000, $100,000, and we have the Tesla shares are $17.38 today. So let's divide that by $17.38. And that hits 5,753 shares. That's how many shares we can buy with $100,000. 5,753. That's a lot of shares compared to Tesla or Apple that's selling at $250 a share, right? We can buy a lot more shares. Now remember, dividends are paid on number of shares you own, not on the value that you've put in, not on the 100,000. We put $100,000 in all of these, same apples to apples, yet we get different numbers. The reason we get different numbers is because dividends are paid on the number of shares you own. So if the stock goes down, you still get your dividend on the number of shares you own. The growth of your company might go up and down, right? Just like rent in your house. If you have a house, if you have 7 doors, for example, and you specify what rent is, it doesn't matter if real estate values go up and down over the year, right? Houses fluctuate in price. They go up and down over the year, but you still get your rent. You still get the same amount of rent. So this is basically the same concept. Now, when using options as your rent or as your dividends, they're going to fluctuate a little bit, all right? But not nearly as much as maybe some other things, like as the value of the stock itself. You're still going to get kind of this little dividend payment that's going to come out. So let's go calculate what that little dividend payment is on Tesla. So we got 5,753 shares, and every month they're going to pay you $1.22 per share. Look at that. I'm not making it up. It's right there on the screen. You can go to FinViz yourself and hover on that little thing and look at it yourself. $1.22 is what they're going to pay you per share on TSLY. Now it's a little bit more volatile. It goes up and down more because it's only one stock. It's not a whole basket of stocks like the S&P 500 or like the QQQ, but they're going to give it to you on one stock because they're selling covered calls, collecting premium. It's not the profits from the company that they're kicking back out as a dividend. This is a different way of generating income for you. Let's go do the math, should we? $1.22 times 5,753 shares at $100,000. Okay, 5,753 times 1.221 equals $7,025 a month on a $100,000 investment into Tesla. That's what I call UBI, universal basic income. I don't need $7,000, Lan. I'm only 25 years old. I could probably live on $4,000. Okay, do you need to put $100,000 into the bank? No, you don't. What you need to do is you need to beg, borrow, steal, save, work your little hiney off, do everything you can to save money and put it into TSLY or a similar fund and let that thing grow, reinvest your dividends until it's paying you enough money that you can have your UBI. That's all I'm saying. Now, the great thing about this company is they don't just do this on Tesla. They do it on Apple. They do it on Google. They do it on a number of different things. Lots of different stocks they do this on. They do this on Bitcoin. All right. So there are a number of companies there's this one new company that's doing this. I call them UBI, universal basic income. You know what? $7,000 a month on $100,000 income is not UBI. That's not universal basic income. What does Elon Musk call it? He calls it universal high income, UHI. This is the replacement for Social Security. Now, is it a little bit more aggressive? Is it a little bit more scary? Is it a little bit more risky? Yes, it is. But risk is what provides income. The more risk you take, the greater the income. The less risk you take, the lower the income. If you want a high income, you're going to have to take high risk. You don't think going out and buying 7 real estate rentals, having 7 doors is risky? Not risky? That's risky. Of course, anything you do is risky. All right. I have a little saying, everything kills you. Pick something fun, right? Everything kills you. Might as well pick something fun. And it's the same thing in the financial world. If you're not willing to take risk, if you're so risk averse that you're not willing to do some of these extra things to make more money, then you should just put your money in Cache Valley Bank or Bank of Utah downtown and get your 1.5% or your 3% a year. That's very safe. All right. You're not going to lose your rent. You don't have any chance of fluctuation in your principal. You don't have any fluctuation in the chance of making or losing. You're not going to make a whole lot of money. You're not going to lose any money. You're very risk averse. You're scared to death of the financial markets. Just go do that. So there's everything in the scale for anybody who wants to do it. Everything from putting your money in a CD at Cache Valley Bank and getting 3% a year, all the way up to TSLY and getting $1.22 per share, or $7,000 a month on $100,000. I'm going to say that's your spectrum. Okay. There's this one way up here. If you want to go all the way to that side of the spectrum, you can. You want to go to this side of the spectrum, go to Cache Valley Bank, you can. And there's everything in between. You just pick your risk. How much risk are you willing to take? JEPI and JEPQ, well, they're not very risky. You can put them over here. You're going to have a little bit, still riskier than Cache Valley Bank, right? Still riskier than Cache Valley Bank, but a lot less risky than going into an individual stock like Tesla. But of course, if you just buy the stock, invest in the stock like Tesla, that's pretty risky too. And if you're willing to do that, why wouldn't you be willing to invest in TSLY? It's the same thing. You're going to have the stock. If we lay them side by side, right? So lay them side by side. They look exactly the same. The only difference that is TSLY gives you a dividend. TSLA does not. TSLY gives you universal basic income, UBI. TSLA gives you great growth. All right. So do you have to do one or the other? No, of course not. If you're going to do it with Tesla, for example, why not do a little bit of both? I have a little strategy I like to use. It's called your age strategy. If you're 25 years old, you should be putting maybe 25% in TSLY, 75% of whatever you invest in TSLA. That's lots of growth if you believe that Tesla is going to grow a lot over the next, 20 years. If you're going to be in it for 20 years, who knows what your ideas are, but you might be saving in there just to buy a house or just to buy a car. I don't know. What's going to work best for you is going to depend on what your goals are, your financial goals. Let's say you're 65, 60 years old. Let's go 60. I'm 60 years old. So let's say I'm 60 years old. Well, I might be wanting to put 60% of every $100 that I invest into the financial markets. I might want to be putting $60 into TSLY to get that dividend income, right? Because I don't want to work. And then I'm going to take the other 40% and put it into TSLY, which might get greater growth. All right. And that I could put in there. And then maybe in the future, I could move it when I get 65. I could move it out of Tesla, take that little bit bigger growth and put it over into TSLY, where I'm going to get that additional income coming in every month. The great thing about dividends and about doing it this way is that you don't have to liquidate your shares to make your money. All right. If you put $100,000 into TSLY and they take out $7,000 every month, well, you still got your $100,000 in there. You still got your number of shares. How many shares did we say? It was several thousand shares, right? Well, you're not liquidating your shares, so you're not liquidating out your holdings. You want to build your holdings up because the more shares you have, remember, dividends are paid out on shares, the number of shares you own. The more shares you have, the more UBI you get. And right now, the shares of TSLY are only $17, whereas look, for Tesla, they're $445. For one share of Tesla's $445. Well, TSLY is only $17. The more number of shares you have, the more UBI you get. I don't even call them dividends. Dividends are profits that come to you from the company, like AT&T. This is not profits from the company. This is profits coming from selling options and collecting the premium. That's how come it's so much higher, because they sell options premium. Lots of people are buying options on Tesla, and there's very volatile. So the options premiums are expensive. So if you give them your money and they trade options with it, they can share that big premium collection with you. That's how it's done. So I don't even call it dividends, because traditionally speaking, dividends are the profits shared with you by the company. And these are not profits. They're options premium. Therefore, I just call them UBI. This company provides you UBI, universal basic income. Let's do a $50,000 because that's a little bit more realistic for a lot of young people. $50,000 is a target that you can hit, right? You're like, oh, I could probably in the next 2, 3, 4, 5 years save $50,000. Maybe you have a job making $50,000 or $40,000 a year. You can say, I can live really skinny. I can, not go to McDonald's every day, not drink coffee every day. There's things that you can do every day to cut a little bit of money and put it in there, because the more shares you own, the more money they're going to give you, right? For every share you own of TSLY, they're going to give you $1. Well, think about that. You go buy a cup of coffee and a sandwich, it's $30 for two of you. You and your girlfriend go out, $30 to buy a cup of coffee and a sandwich, and you share the sandwich as one sandwich, right? Well, $30 you paid for the sandwich. Well, if you would have put that $30 into Tesla, you could have had 2 shares. That would have been $2. Look at how quickly you could start paying for your coffee and sandwich just with a few shares of Tesla. And it comes out every month. That's pretty cool. It pays to you every month. And it's just like clockwork, but it goes up and down. It'll go up and down. Let's go look and see how much it goes up and down. All right. So this is TSLY, and this was the last one. December's dividends were $1.22 per share. Let's go back and see what November's were. 59 cents a share, almost half. Let's go back to October. Oh, it was $1 in October. And in September, it was 81 cents. And here at 96 cents. And here it was $1 again. And here it was 64 cents. And here it's 69 cents. And here this is 68 cents. And here it was 81 cents. So it changes. It changes based on what the market's doing, because how many options can they sell? If the market's going crazy like it is right now, look at how crazy the market's going. Well, options premiums are very expensive. It has to do with what they call implied volatility. All right. So implied volatility will determine the value of the options. They get very expensive if the market's going crazy. And so they're selling these. And so if they're very expensive, they make more money. So it makes sense, right? A little quiet market, well, it's less money. That's why the S&P with JEPI and JEPQ is a lot less money, because it's a quieter market. It's spread across 500 stocks, not just one very volatile stock. Now, maybe you've heard of a company called Google. Some of you might have even used their service. All right. Maybe you have Gmail, or maybe you search on the internet with Google. Yeah, ever heard of Google? Pretty good company. Most people have heard of it. Let's go look at what Google has. All right. GOOG, and they have a couple. We're going to trade the GOGL. All right. So this is Google, and you'll notice that they do pay a dividend. There it is, every quarter. They pay you 20 cents, and their shares are $197. You can do the math. It's very simple. Take your $50,000, take your $100,000 divided by the number of shares and multiply it by the number of dividends that they tell you on this little FinViz thing here, or on YouTube or Google or wherever you want to go to get your dividends. And then that's where you can do a multiplication. Let's go see what Google did on the last one right here. They did 20 cents. So Google straight up gives you 20 cents. But did you know Google also has one that gives you dividends on the options? So let's go GOO. I think it's GOOY. So let's go GOOY. Now look, every month they kick out dividends. This is Google, and selling options. The last time they paid dividends was 28 cents. Okay. So 28 cents every month. That's pretty cool. And look at the cost of the shares, $15. $15 per share. So you can buy a lot of shares with the $50,000 and then get 37 cents per share. You can get 28 cents. You can get 25 cents. Google's not nearly as wild and crazy. It doesn't have an implied volatility nearly as high as Tesla, for example. And so you can get the dividend on here. And all you have to do is give them your money, and they'll trade it for you. You don't have to trade options. Now, I teach options. If you come to my YouTube class, I spend hours every Monday, Wednesday, and Friday, right? Every Monday, Wednesday, and Friday, every morning, 8 o'clock, I teach options. I teach you how to do exactly what these guys are doing, only we do it ourselves. Now, if you give your money to them to do it, they're going to make this much money. And I'm showing you how much it is. It's a lot of money. All right. If you do it yourself, you can make more. There we go. We're back, I think. Hopefully you guys see me back. I had a bit of a glitch on my side. Things disappeared and then they came back. All right. So that's the name of the game. We're going to try and do it ourselves. You can do it yourself and make more money. I like to do both. I like to have kind of this dividends coming in. And I've started to move more of my money into some of these higher dividend stuff because these are relatively new. I mean, you say GOOY and you look, it's got a history on there quite a bit, but it doesn't go back much more. If we go back to the weeklies, you can see they just started this 2 years ago, not even a full 2 years of history on this. So this is relatively new. And you can see that Google has been going down. So if you would have bought it at the very beginning, your shares would have been at $20. Now they're at $15, but they'd have been paying you a dividend that whole time. So the value of the house in this case, if you're comparing it to your rental, the value of the house in GOOY went down, but that's because Google's shares went down. They were selling premium against it with options, so they were paying you options premium the whole time that you were doing this. Now Google's starting to go back up. So if it just goes down, we don't want it to go down. We want it to go up, right? Obviously, we want it to go up. So it's starting to turn and go back up now. So it's going down. Now it's cheap, right? It's $15, $14 a share. It was at one point, this fund was $20 a share. So it's gone down $5. It looks like a lot, but it's more like this. It's only gone from here to here is only $5. That's not a lot. I mean, it's a lot because it's not very much. It's $20 to $15, but it's gone down 25%. But it's also giving you huge dividends that whole time. So you have to take that into consideration, and that's another thing that we teach here on the class. We teach you what we call accumulation distribution model, and we teach you the Wyckoff theory. All right, so the accumulation and distribution model, when you're trading these types of stocks, is extremely important. It's also the dollar cost average theory. So you have to understand how to dollar cost average so that you're constantly bringing your cost of each share down, because you want to get the shares at the lowest price. So you want to buy low, sell high, right? So you can continually do what we call rotate, or reinvest your shares as the market comes back down. You want to reinvest when prices are low, not when they're high. So if you're thinking of getting into Tesla right now, that's one of the problems. Is if you go into Tesla, let's go TSLY. If you're going to go into Tesla, go to a daily chart, look how high it is right now. It's really gone up into an extension, right? So it's quite high. It's coming up here and testing a previous high at 1773. The question is it going to pull back, and would there be a better time to get in? Well, if you want your UBI and you want it right now, you could put your money in now. The stock could fall. You're still going to get your monthly UBI, but you're going to lose it on the growth, right? If the market pulls back. So if you wanted to wait for the market to pull back and then get in, then what I would tell you is, you know what? You can go along and see these little spots right here in this. This is the RSI indicator. Many of you are familiar with the RSI indicator. If you look at the RSI indicator, when it's down here in these little regions, this is a good spot right here to be buying your UBI, right? To get your UBI. So these are good times to be putting in your shares. I'm not very good at this tool. So this is a good time to be putting in your shares into this market, because that's when the RSI is low. So that's the accumulation distribution model, right? So you want to bring your dollar cost average down. So you don't want to be buying into these in this one here, in particular TSLY. You don't want to be coming in to this one here. That's not a good place to be putting money into TSLY. Why? Because it's way overbought and it's probably going to flush down a little bit. And in this case it did. And here's another one right here. You got, let's grab the right tool. So we're going to come in here, and that's another spot you probably don't want to be buying into TSLY, which is where it's at kind of right now, isn't it? So we have to be careful, and we still have to trade. We still have to be smart about when we're going to get into these markets. Look at this one here. So you got the same thing happening right now. It's going way up into the upper region. So probably want to wait to see if the market's not going to pull back. Now it might not. It might just, it might just take off and go to the moon and go straight up and out of there. But that's what we look for. We want to see this market rise. So maybe right in here, if we could get a little bit of a pullback, we might want to be buying in that region. So it's up to you when you want to put your money in there to start collecting your UBI or your dividends. All right. So let's go look at another one. Let's go look at Google, GOOY. All right. So here's GOOY, and it's a little bit more stable. It's not nearly as wild and crazy as Tesla. And as you can see, it's given 28 cents per share on $15 per share. So you can do the math on that one and see what your UBI would be. But here's another idea. How many of you know, we've talked about Google, we've talked about Tesla. What about Apple? Apple, they do it on Apple. You can buy shares on Apple What about Meta stock? You know, Facebook. How many of you have ever heard of the Mag 7, Magnificent Seven? All right, that's the 7 biggest tech companies in the world. There's actually a stock, MAGS, an ETF that you can trade. Look at this. There's MAGS. That's what we call the Magnificent 7 ETF. And you'll notice it gives no dividends. Why? Because these companies don't give dividends. They have nothing dividends. All right. It's almost nothing. If you come down here, you can see that they have Tesla is in there. 12% of it's Tesla. Amazon, 8.32. Alphabet, 8.31, which is Google. Here's Tesla again in there, another 8%. They got a lot of Tesla. Oh, that's a Tesla swap. So that's a little bit different. And then you got NVIDIA. NVIDIA's in there. You got Meta, which is Facebook. You got Apple. See that? Apple's in there. Microsoft's in there. So those are your Magnificent Seven. 7 great stocks. You probably, if you're in the stock market, probably own anyway. You probably have Microsoft. You probably have Apple. You probably have Meta. You probably have NVIDIA. You probably have Tesla. You probably have Google, right? You probably got this little portfolio of these great stocks. And you're like, yeah, I'm really cool. I got all that stuff. Well, you can do it with a single stock called MAGS. Just put your money into MAGS. And you can see MAGS is trading at $57 per share. It's only $57 a share to put it into MAGS. And now you own all those stocks at one time. That's pretty cool, right? That's why MAGS is created, so you can just buy the Magnificent Seven with one purchase, and you don't have to go and buy $400 of, of Tesla and $250 of Apple, and then, and kind of spread your shares across. It gets more difficult to manage it on your own. Just come buy MAGS. Guess what? MAGY. I think it's MAGY. No, it's not MAGY. It's MAG. Uh-oh. I'm going to have to go look it up. I forgot it. Hold on a second. I got it right here. I can find it real fast. I can look on my other screen because you know what? I own a bunch of it. Hold on a second. I thought it was MAGS. No, I'm showing my bad memory. I am 60. I know there's some of you guys out here are even older than me. You understand? Oh, I got it backwards. It's not MAGY. It's YMAG. YMAG. All right. There we go. Excuse me. Now, this is the Magnificent Seven, exactly like MAGS, which is just your growth. Put your money in there, and you've got it shared across those big ones. This is the one that's going to give you the dividends. Now, what's cool is look at this. This is really cool because they used to do it monthly. Look at when they used to give you your dividends monthly. Now they give you your dividends or your UBI weekly. If you go put your money into YMAG, they give it to you every single week. Now, what does that mean? That means compound interest is now you're getting free money on free money more quickly. Every week you get free money, and you get I call it free money. It feels like free money, right? Feels like free money. They're just giving you free money. So it's rent on your house. I own the house, but I get rent. Rent feels like free money, right? So you didn't have to work for it. All you had to do is buy the house and put somebody in there, rent it to them, and they give you free money. Well, that's the same thing. The problem with that is the bank owns the house, right? We're going to try and do this without borrowing money. I mean, you can borrow it if you want to, but I'd recommend you probably not do that to put it in here. You could. You talk about our risk and aggressive. That's getting way over there. You're going to start borrowing money to put it in here to collect the premium to pay back the loan. That's crazy money. You can do that. All right. You can do that. But we're going to go out and we're going to sell our cars. We're going to sell all the junk that's in the garage. We're going to do all the stuff that we can to sell and get as much cash as we can. And we're going to put it into YMAG because it's the Magnificent Seven. It includes Tesla. It includes Google. It includes Microsoft. And they pay it out, our UBI, every week. And they do it at $16 or 16 cents per share. Now, let's do the math. All right. It's going to be a lot more conservative than just going in and doing Tesla all by itself. So we're backing off here, but it is every week. So 16 times 4 is what you're looking at. All right. 17 times 4. So to compare apples to apples versus the monthly version. All right. So let's come in here and do YMAG, and we're going to do this every week, not every month. So now we're going to take our $100,000, do our $100,000. We're going to sell all the crap in the garage. We're going to sell those old 15-year-old four-wheelers, get $1,000 out of them, and we're going to put it into YMAG. And we're going to get enough money that we could go buy a new four-wheeler, right? Make payments, whatever you want to do, however you want to spend it. This is your UBI. This is replacing Social Security, which the government's not going to have any longer anyway, right? Everybody says. So we're going to come in here and we're going to go divided by 20.16. So we got 4,960 shares of YMAG with $100,000, and we're going to get 16.8 cents every week. So let's do that. Times, now we got to take our 4,960 times. How are we going to do this? We got to do 52 of them, not every month, not once a month. So we're going to go 16. So we're going to go times 16. Let's see, I got to do 0.168. Oh no, I got to take this. Oh, I did it wrong. Losing my brain. All right, 100,000. And we're going to divide that by the number of shares. That's what we have to do first. Divided by 20.17. See, this is really hard. Equals. So with 4,957 shares, and we're going to get times 16 cents, 17 cents, 0.17. So we're going to get $842 a week on MAGs with $100,000. Now, let's multiply that times 52. That's going to give you $43,000 a year, basically, if they do it the same. And, 16 cents. Let's see, this one here was 27 cents, much more. 20 cents. That one's 6 cents, 21 cents, 20 cents, 15 cents, 5 cents. Had a bad one there. 22 cents, 28 cents, 16 cents, 17 cents. So it's not exactly every month, and we can deal with that, right? We understand that. But the last one they did was 16 cents. So that would give you $43,000 a year in UBI on $100,000 investment. That's pretty cool. I think it's pretty cool. And I just wanted to share that with you. So if you just wanted to put $100,000 into YMAG and make $43,000 or $800 a week in dividends, you could do that. All right. You could do that. All right. That's what I had for you today. And let's go over and say hello to a few people. There's John C. coming in with the gold. There we go, John. It's nice to see you. Glad to have you out here. Hope you enjoyed the lesson today. Bruce coming in with the silvers. Nice to see you out here, Bruce. And we've also got Kirk Schwartz. Nice to see you, Kirk, coming in with the bronze. We got Gary Thomas saying hello. It's great to see you, Gary. And Rock Steiner coming in saying hello. And we got a little, I think I have a little Sunday school lesson for you. So if you want to hold on for a second, let me pull that up. I'm going to go watch our little Sunday school lesson. Trading is profound, yet it's insignificant. What we do is vital, yet it doesn't matter. If we don't do it, nobody knows, right? But to us, it's vital and it's profound, yet it's insignificant to others. We work alone. We sit here, right? And we do most of this all by ourselves, yet are swayed by the power of others, right? And unseen forces. We are brave, yet terrified. I think that says trading to a T. We are brave, yet terrified. Trading is a crushing chore and a wonderful privilege. And mostly it's a crushing chore because we sit here by ourselves and we are brave and terrified, right? Only in play do patterns emerge. And so clear your mind and get back to work. All right. That's my Sunday school lesson for you guys today. And that is Tesla and Tesla and Jeppy, JepQ, AT&T, and a little lesson on dividends. If you guys had fun, give me a little thumbs up. That's always nice. If you like this kind of lesson, it's always great to see a few thumbs up out there. And I will see you guys tomorrow for Power Hour. All right. We're coming into Christmas holidays. I think we're going to have, I think Wednesday will be our final class this week. and then we might take a week off next week. So we'll see. We'll see how the cookie crumbles. But right now, we got Tuesday and Wednesday. I think we're going to be in class, and we will see you tomorrow for Power Hour. Take care.